Hi, my name is Drew Crawford. I'm the managing partner of Austral Continental. Austral Continental connects U.S. institutional capital to Brazilian hard assets. And two of our main areas of focus are agribusiness and critical minerals. And one of the places where those two meet is fertilizer. So quick disclosure before we start, Austral Continental is a paid strategic advisor to Brazil Potash. So treat this as sponsored commentary and not investment advice. The compensation is cash only with no stock options or success fees. And the analysis here is my own. So I spoke with Mayo Schmidt recently about this project, why this project matters at the market level. And today I want to go a layer deeper into how it actually gets built and financed. And for that, the right person is Matt Simpson. Matt Simpson is the Chief Executive Officer of Brazil Potash, and he's led the company through permitting, the New York listing, and now into the construction financing phase. So I visited Autazes at the end of April, so I have seen the site and the community work firsthand. Matt, thanks for taking the time today.
Thanks for having me on, Drew.
So two things have moved since Mayo and I spoke at the end of June. The first is the USMCA joint review happened on July 1st, and the US declined to renew the agreement in its current form, though tariffs did not change. The deal runs to 2036. And also, forecasters are pointing to a potentially historically strong El Nino peaking late this year, landing on Brazil's next crop cycle. Both of those reinforce the case for domestic fertilizer potash supply in Brazil, and Mayo covered that ground well. So today I want to spend more of the time on the part that decides whether it actually gets built and which is the capital. So when it comes to the capital stack, Matt, walk us through the capital stack as it stands today of total project CapEx, how much is targeted for build, own, operate, transfer carve-outs on power, port, and plant, and how much for construction debt, and what is SUFRAMA relief cover, and what is the residual equity requirement?
So, Drew, I think for this question, I'm going to put up one slide because I think it's quite helpful for your listeners or viewers to see how this capital stack comes together, because it's a lot of information that I'll be sharing in a fairly short period of time. So let me just put this up full screen for people. There we go. So our initial capital for construction of the project is $2.5 billion US. But it's really important for people to recognize that with any construction project, there typically is also a working capital requirement. And this working capital requirement covers some of the interest payments that will need to be made during construction. It covers fees to our bankers. And that means that peak funding that we actually need to raise is more like $2.8 billion. Out of that $2.8 billion, we do have a binding royalty agreement with Franco-Nevada. Franco-Nevada is one of the biggest royalty streaming companies in the world. They have about a $50 billion market cap. And in exchange for a 4% gross revenue royalty, they will invest about $150 million. And those funds get triggered once Brazil Potash makes a final investment decision to construct the project. On top of that, we expect to receive about $350 million of what we're calling a build, own, operate, transfer contract. So it's just like it sounds, Drew. The plan is that there's a third party that would build our 102-mile power line. They will own that power line, operate the power line, but amortize the initial cost over a period of somewhere between 20 to 30 years, post which they then transfer ownership of that line to Brazil Potash. The beauty of this is that we take about $350 million out of our capital and transfer it to operating costs. Of course, we're going to need to pay a return on investment to the boot investors, but given that the operating margins are so high on this project, the benefit to investors is much less equity dilution. So in addition to the power line, we're looking at replicating this model with the 20 megawatts of power that's needed for construction that becomes our backup power, potentially with our steam plant, our river barge port, the trucking service from the plant to the port, and then also with our water. On top of that, you mentioned SUFRAMA. SUFRAMA really is tax exemptions. In our case, it's roughly $100 million. So that leaves about $2.2 billion, out of which we expect using about a 60% debt to equity ratio to get about $1.8 billion of debt, mostly through development finance institutes, and the balance about $400 million of equity. Keeping in mind today that we have about 80 million cash in hand, plus we have about 14 million warrants with an exercise price of $3 each. So if all of those get exercised, it brings about another 40 million. So the target equity raise will be somewhere around 300 million.
Okay, that makes a lot of sense. And what is the balance sheet fund today, and what has to close before you are through the current runway?
Well, right now, again, we have about 80 million cash on hand, and that is more than sufficient to complete what's called front-end engineering design. And front-end engineering design is absolutely critical for the lenders that will provide the debt funding for construction as a prerequisite. And it also allows us to complete all those different boot contracts that I mentioned earlier on, which again are going to be really important to demonstrate to investors each time that we make an announcement. There'll be an MOU followed by a binding contract that we're executing on this plan to build.
Okay, that's great. And when it comes to the feed and the capex, confidence, and the feed is the step that turns a study estimate into a bankable number, right? So what has it done to the capex figure and the contingency? And is the contracting strategy lump sum turnkey or EPCM?
So the front end engineering design really is to bring the cost estimate for construction of the project to a level of accuracy that will meet the needs of the lenders. So what that means is that in our case, especially because we're listed in the United States, we need to have a feasibility study with a plus minus 15% or better accuracy. We need to have monthly resolution of the expenditures during the construction time, and then quarterly resolution of the cash flows for the first 10 years of operation. So this again will provide much greater resolution so that the lenders can then provide cash flow profiles on what the funding trajectory will look like. As far as the contracting strategy goes, we're still considering whether this would be a lump sum engineering procurement construction contract, or as you mentioned, an engineering procurement construction management contract. And there's benefits and negatives to both of those contracts, Drew. A lot of people get really excited about having a lump sum EPC contract because they believe it completely mitigates the risk of any sort of cost overruns. But what they don't necessarily realize is that the engineering firms that provide that will always require some contingency on their side. So they'll actually increase the estimate because they don't want to take that risk on either. Conversely, if you go to an EPCM contract, the construction company will be a lot more aggressive in their estimate because they know that any cost overruns would be borne by the company. So in this case, what happens is the banks will typically require either a parent sponsor guarantee. So if we end up having an anchor equity investor that's a major mining company or a major agricultural company, they might be willing to say that we will cover any cost overruns. Or what happens is the banks typically require that you actually add additional funding in the debt to cover cost overruns. And that could be several hundreds of millions of dollars potentially. So at the end of the day, the expression is there's no free lunch. We're going to look at both strategies and fully cost them out, whether we get a lump sum EPC with a total cost basis or an EPCM with a higher cost overrun or a sponsor guarantee.
Makes a lot of sense. And going back to the slide that you just shared before, we talked about the anchor capital. And I think one of the important things is to understand who's at the tables, right? So who is the natural anchor for an asset like this? Is it a fertilizer major, a trading house, an infrastructure fund, development finance institution? And maybe you could give some more background in terms of, our IDB Invest, DFC, CAF, or BNDES part of the conversation. How much of that raise aimed at Brazilian institutional capital rather than only North American investors?
So there's several different groups currently under NDA that are considering anchor investment in our construction. And this includes both multinational companies, mega farmers, agricultural focused investment funds. And then on the debt side, we are talking to several development finance institutes, export credit agencies, and banks. We're intentionally casting the net really broadly at this point in time because we don't know where those funds will ultimately come from. And ideally, we will have a mix of international investors that participate alongside some of the Brazil government-backed funds. So more than likely, we'll see the bulk of that debt taken up by these development finance institutes and export credit agencies. And that anchor equity, again, it's hard to say at this point whether it would be an incumbent fertilizer producer or a multinational mining company or even just a private equity fund that really likes the agricultural space.
I love that. And when it comes back to the offtake bankability, I think one of the strongest assets of this project, or the strongest angles, is roughly 90% of the production is already pre-sold on long-dated contracts. So how are those agreements structured in terms of take or pay and tenor, and how are lenders treating that book as they size the construction debt?
So I think it's really important for viewers to understand that banks and development finance institutes want to always minimize risk. And what that means is that they do not want to take any risk on our ability to sell the potash, despite us being in the backyard of the world's largest consumer, with a product that people have no choice but to buy because we all have to eat. So that's why these offtake agreements were put in place, is it takes away the risk for the bank's perspective of us being able to sell our product. Now, in this case, all three contracts are on what's called a take or pay basis. And just like it sounds, Drew, it means that we have to supply the potash and that the buyers need to take it. Otherwise, there are penalties in the contract structure that cut both ways. The pricing in the contracts is a bit different. We really have kind of two different structures. We have Amagi, which is one of the biggest farmers in Brazil. And that contract is a 15 to 17 year contract based on the spot CFR granular myriad of potash price plus inland freight minus a single digit price discount. So today, for example, potash is selling for about $400 a ton into Brazil, and our inland freight savings would be probably somewhere around $35 to $60 a ton on top of that number. So if we're in operation today, we'd be selling for about $450 a ton, minus again a mid-single digit price discount against a cost to produce of about $80. So the margins are phenomenal. With Key Trade and Camille, it's a little bit different because these are fertilizer distributors as opposed to end consuming farmers. And with both of these contracts, they're 10 years in duration. So that duration was intentionally selected to cover what's likely going to be the tenor of the loan. But then the pricing is unique in that it starts off with the CFR Brazil granular price minus a marketing fee, but then we share disproportionately to Brazil Potash the actual price that they sell the product for. And the whole thinking behind this one, Drew, is I didn't want these distributors to just place the tons with anyone as quick and easy as they could. I wanted them to work harder to sell our potash to farms that are located as close as possible to our operation and furthest away from the import ports to really capture that freight savings, and also to extract a what's called value and use premium, because we expect that our product is probably going to have about 1% to 3% fines in it versus imported product that is upwards of 10% fines. And that's important because what the farmer is buying is a small granule that you want to drop on the farm field, not dust. So when I talk about that word fines, it really is dust that could blow anywhere.
Yeah, I think it's really important. And there's something else that's currently happening here in Brazil, maybe that people outside of Brazil don't understand, which is Profert. Profert was pulled from the Senate floor on July 14th. It is now set for the first week of August, with the chamber version running the program from 2027 and 2031. Does that timing intersect with your construction schedule, and what is the sequence of milestones from here to a construction decision?
Yeah, I'm really glad that you brought up this question, Drew, because a lot of people probably don't understand exactly what Profert is. And well, in a nutshell, what it really is Brazil's government legislation that's aiming to be passed to promote domestic fertilizer production, because Brazil does have a stated goal to reduce their import of nitrogen, phosphate, and potash fertilizer from the current roughly 85%, about $26 billion a year, down to 45% by 2050. So with this legislation that will substantially benefit Brazil Potash, should it be passed, it includes tax exemptions, financing and credit guarantees, and mandatory blending requirements. So for Brazil Potash, when we talk about tax exemptions, it's really more about tax exemptions for the purchase of construction materials and equipment. The headline that people will read is tax exemptions from corporate profits, but the period that this is initially envisaged to occur largely overlaps our construction period. So for us, that's not as applicable as the exemptions on taxes for materials and equipment. On financing and credit guarantees, this really means that there's a focus by groups like the BNDES, Sudan, to construct or fund the construction of fertilizer plants, their expansion and modernization. So we should benefit from some preferred financing or credit guarantees. And then on the blending requirements, it's more of a future-looking thing where the government is requiring at least 2% domestic content initially, and that could scale to anywhere between 10 and 30%. So it's going to force people to favorably purchase from companies like Brazil Potash, which only makes sense anyways because of our inland freight differential.
Yeah, that's huge. And I don't know if most people realize how important domestic production for potash is in Brazil. It's the product that the country needs, and being one of the largest agricultural producers in the world, it only makes sense. So last question I have for you, Matt, as the project moves from permitting into construction, what changes on the ground in terms of local hiring and community engagement are you guys currently working with?
So several months ago, Drew, we signed, I believe it was 14 different partnership agreements with local Amazon state government agencies to provide training in the local region. And for us, it's extremely important from a sustainability standpoint to hire as many people as we can locally. And as you saw firsthand when you came to site, there is a community called Autazes that has about 40,000 people that live in it. And the skill level in this community, though, is quite low. So in order for these people to be able to be meaningfully employed with Brazil Potash, we need to provide them with training. And this training is going to be quite diverse. It'll include everything from learning how to maintain and operate some of the equipment that we'll use, all the way through to people that might want to start their own company and provide goods and services to us. There might be some people that love to fish, and how do they monetize that business? Well, we're in a need to feed our employees. So here's an opportunity that all of a sudden you could start your business supplying fish to our company. Or maybe you always dreamed of being an electrician or a mechanic. We want to provide that training to give people the opportunity to work for us. And it's a win-win, because by hiring people from the local community, they're also much more likely to stay.
Yeah, that was actually one of the things that most stood out to me during the site visit, was just the excitement of the local communities to really get behind the project, and what you guys are doing there to help local communities when it comes to sanitation, water, access to internet, and really that synergy between the local community and the company, and really bringing improving the lives of the local people. So I mean, I think it's a great combination, a great relationship that you guys are building there. So Matt, thanks again so much for the time and for going into detail on the capital side. For anyone watching, the full disclosures in the description. And if you guys want to read my article about Inside Autazes, you can find it on X and LinkedIn. And Matt, thanks again. I really do appreciate it.
Thanks for having me on, Drew.